The stock market crash of 1929, known as Black Tuesday, was a monumental financial collapse that marked the beginning of the Great Depression, a global economic downturn that devastated millions. While specific events triggered the crash, deeper economic issues during the 1920s, including speculative investments, an overextended credit system, and structural weaknesses in the U.S. economy, were the root causes. The Roaring Twenties was a decade of economic prosperity and cultural shift. Emerging from World War I as a strong economy, the U.S. experienced rapid growth in industrial production, technological advancement, and consumer spending. Mass production techniques transformed manufacturing, making consumer goods like automobiles and household appliances widely available. Many people started purchasing these items on credit, and the stock market became a popular investment avenue for average Americans due to rising stock prices. By the late 1920s, a speculative bubble had formed with many buying stocks on margin, borrowing money to purchase more stocks than affordable. This reliance on margin buying led to inflated stock prices, driven by optimism rather than company performance, creating an unstable financial situation. Economic weaknesses were evident despite the boom. The agricultural sector struggled with falling crop prices and rising debt. Overproduction led to unsold inventories and falling profits, and income inequality limited consumer demand. Globally, European economies weakened by World War I could not buy American goods or pay off debts, contributing to economic slowdown. The crash began in October 1929, with Black Thursday seeing a sharp fall in stock prices, leading to panic selling. Despite efforts to stabilize the market, Black Monday saw a 13% drop in value, and Black Tuesday witnessed over 16 million shares traded with a further 12% dip. By month's end, a significant portion of the market's value was lost. The crash catalyzed the Great Depression, causing widespread bank failures, a collapse in industrial production, skyrocketing unemployment, and a decline in consumer spending. The global economy was also affected. Initially, President Hoover's government took a hands-off approach, but Franklin D. Roosevelt's New Deal brought in reforms and public works programs, stabilizing the economy. Key measures included the establishment of the FDIC, public works programs to create jobs, and financial regulations to prevent future abuses. Full recovery was only achieved with World War II's industrial demands. The causes of the crash were largely speculation, overextension of credit, lack of regulation, economic inequality, and an agricultural depression. The stock market crash of 1929 remains a pivotal event in economic history, illustrating the dangers of speculative bubbles, insufficient regulation, and economic disparities.